Hello, everyone. Welcome to IR Insight Live, powered by Nasdaq IR Insight. I'm your guest host today, Lori Coulombe, and joining me is Masood Ghaussi, Senior Analyst from our Nasdaq Advisory Services team. Welcome back, Masood.
How's it going, Lori?
Great, thanks.
So 1-800-Flowers was here this morning, ringing our bell. Understand you're a mother. Happy Mother's Day, and happy Mother's Day to my mother.
Wonderful.
And all the mothers out there.
All the mothers out there. Thanks. So to get started, just fill us in. What's going on in the markets?
Yeah, sure. So ever since the February and March correction that we saw, PEs fall from about 18 times to 16 times. Markets have been trading mostly sideways. Reason being, we have the bulls. The bulls are those that believe in the growth narrative. Essentially behind that is the tax cuts and the Trump administration's deregulation efforts, which has brought the markets back alive like back in 2017. And then we have the bears, and the bears are essentially those that are looking at the inflation numbers, those are looking at the anti-trade policy and sentiment, and also those that are focused on the interest rate number, where interest rates are headed. In terms of some of the risks with respect to inflation, we saw the Fed speak. The Fed has turned relatively dovish on the growth theme, and they have turned hawkish on inflation. We're seeing some inflation numbers tick up. Oil prices are higher. In terms of the anti-trade policy and sentiment, we saw the manufacturing index soften slightly. Also, the agricultural index softened slightly, and GDP numbers came in at 2.3%. It beat expectations, however, softened from about the 3% levels we saw the last few quarters, and in line with historical average of 3%. So mostly expect some turbulence going forward with respect to interest, the Federal Reserve normalizing monetary policy.
Okay. Well, in light of what you just discussed, tell us what's going on with the yield curve. Like, why is it flattening?
Yeah, so the yield curve, if we break it down and look at what it is on the short end of the yield curve, namely the 2-year and 5-year notes, that's a reflection of where interest rates are going, and that has been going up. The 10-year and the 30-year notes and bonds, that has always also been going up, and that's a reflection of growth and inflation in the economy, but it has not gone up as much as the short end of the yield curve. So what we're seeing is essentially the yield curve flattening, and the risk there is that if it inverts, it's usually an indication of a recession looming. So investors and traders are worried about the yield curve inverting. Now, the yield curve has been the narrowest it has been since, I think, over a decade, back before the financial crisis. And there are two competing, or I should say two various competing theories as to why. The two most relevant are, one, investors in the debt market are nervous. They're skittish about future growth because of what we discussed earlier. So that's one side of the equation. The second side of the equation is with all this global loose monetary policy, accommodative monetary policy that we've been seeing over the last 10 years, it has juiced up returns. Investors are chasing yield. So anything that's clipping a healthy yield, investors are buying up. And I prefer the second theory as to why the yield curve is flattening, and hopefully we shouldn't see a recession, and hopefully we should not see the yield curve inverting.
Got it. Well, turning to CapEx. So CapEx numbers seem encouraging. So what does that say about the health of corporate America?
Yeah, so a couple of things here. One, we saw the non-residential fixed income figures come in around 6%. This is very strong numbers. This is essentially business investment. Point being that businesses are investing more money, more capital expenditures. As such, it's a reflection of the future state of the economy, and we should reap the benefits in future quarters. So we have that. Two, there was a UBS report that came out, and of 130 companies that have released earnings so far, capital expenditures is up 39% year over year. These are some very strong, encouraging numbers. This far outstrips dividend and share buyback figures, which have also gone up. Thirdly, fund managers are preferring that corporations redeploy capital into capital expenditure, as in spend money on essentially plant equipment and invest in the business. And this should create higher wages in the future and more employment opportunities. And finally, a Goldman report that came out looked at companies that have hike dividends or increase share buybacks versus those that put money to work into capital expenditures. And it seems as though the latter camp, companies that have redeployed capital back into CapEx, have beat the former camp by approximately 5%. So that's pretty much what's going on with respect to capital expenditures and business investment.
Thanks, Masood. Thanks for great insights today. And thank you all for joining us on IR Insight Live. We look forward to seeing you again on Thursday. Have a great day.